Have you ever tried to buy the dip and it just kept falling? When the stock market drops quickly, it does create rare opportunities. Many companies will be oversold purely out of fear. Others will be sold for good reason, and that's why we have to be careful. But at the same time, the window of opportunity could be shutting quickly if the market bounces back. This is my YouTube portfolio investing series where I invest in a different company every week. This week, I am making the case for PayPal. I will be reviewing their financial statements, the company's own forward guidance, revenue predictions by the analysts, and then putting that all together to calculate PayPal's intrinsic value. When I say intrinsic value, I mean, if I was gonna buy the company today, what would that company be worth? How does that translate to share price? And the way I'm calculating what the company's worth is by discounting their future cash flows. The best way to think about that is if I were to buy a bond, and this bond is gonna pay me $5 a year for 20 years. Okay, that's $100 over 20 years. I certainly wouldn't buy that bond for $100 because then I would just be getting paid back over 20 years with zero interest. No, I would want to discount those future cash flows by some discount rate. Now, in PayPal's case, it's not like a bond. I'm not going to be getting exactly $5 a year for 20 years. I don't know what I'm going to be getting. I have to project the future cash flows and then discount those cash flows by my perceived risk level and the return that I want to get over that time. To find PayPal's financials, I like to use stockanalysis.com. They are trading at $62.57 currently. Here's the financials tab. But first, I like to use a little bit of a shortcut. This is my automated spreadsheet right here where I type in the ticker and it runs through the calculations automatically. It pulls information from stockanalysis.com to make this process faster and easier. And I have a supplement page back here at the back where it automatically calculates red flags for a company based on Warren Buffett's own red flag. In this case, if a cell is highlighted green, it's a green flag, meaning it is strong evidence that PayPal has a competitive, durable advantage. And if it's red, then it's a red flag. It means the company is more risky in that particular regard, and they are unlikely to have a durable competitive advantage. The white cells are somewhere in between. So right off the bat, I can see that PayPal does not have any red flags. I see a bunch of green flags, except for one red cell, but this is in fiscal year 2022, where their profit margin dipped below 10%. So in Warren Buffett's eyes, profit margin below 10% is a red flag. Profit margin over 20% is a green flag. Unfortunately, PayPal does not have over 20% profit margin, but their gross margin is above 40%, which is a green flag. Now, the two cells that really stick out to me the most when I'm looking at companies while the stock market is dipping, and this one right here, interest income percentage as a percentage of their operating income. A company's interest expense is the amount that they have to pay to service their debt. If they're having to spend a high percentage of their operating income on debt, that is bad. And it means if a company is having revenue problems in the future, then they may have to pull out new debt to service their current debt, which leads to a ballooning interest payment. So I like to see a low percentage here. Buffett likes to target companies that are under 10%. PayPal only needs to pay 6.78% of their operating income on their interest expense. In this cell right here, their long-term debt. This number is calculated by taking PayPal's long-term debt and then dividing it by their profit. So in this case, what this tells me is that PayPal can pay all its long-term debt in about 2.5 years if they were to use all of their profit to do so. Warren Buffett likes to look for companies where the ratio is under 5, PayPal is 2.5, so that looks really good. Now that I can see that there's not any glaring weaknesses that jump out at me, I'm gonna go ahead and go to PayPal's financials. Starting with their income statement, I can see that their revenue has gone up. I'm seeing a green number here in the percentage. This is the revenue growth year over year. If I go back 10 years, which is how far stockanalysis.com lets me go, it's all green. That looks good. Their selling, general, and administrative expenses and their research and development are relatively low. That's good. That's also a cell that I automatically calculate on my spreadsheet here. For selling, general, and administrative, it's 32% of their gross margin. For R&D, it's 23%. So Warren Buffett likes as low as possible on those. These aren't red flags and they're not green flags. One thing I really like to see is the shares outstanding. In this case, PayPal's shares outstanding are consistently going down. I'm seeing a green negative percentage right here in the shares change year over year. I have to go all the way back to 2017 and 2015 to see that they actually had to issue shares overall in those years. I like to see the share count going down every year because that means if I own a share and then their share count drops, it means my shares become a greater piece of the pie. So income statement looks solid. Next up, balance sheet. Here is another indicator that PayPal is not at risk of running into debt troubles. So currently their cash and short-term investments, $10.8 billion. If I scroll down to their total debt, total long-term debt, $9.8 billion. So they have enough cash right now to pay off all their debt if they wanted to. That is a really good sign. A couple things that also jump out at me that I think look really good about PayPal is their long-term investments continue to go up. Their goodwill has for the most part gone up year over year. What goodwill means is when PayPal acquires another company, they're going to pay a small premium. They're not going to be able to pay exactly what that company is worth in terms of their property, plant, and equipment and all of their tangible assets. There's going to be intangibles that you have to pay a little bit more for, like the relationships that they have, their brand strength, and goodwill represents the premium amount that PayPal had to pay to acquire those businesses. So you want to see goodwill continually going up. If goodwill ever takes a hit, that means that PayPal has to admit that they overpaid for something and the company or the acquisition was not worth what they paid. So in this case, for the most part, I'm seeing this number go up over time. It looks like it has gone down just slightly since 2021. So maybe a slight red flag there, but not too bad. The next thing I really like to see is retained earnings. This number going up every single year is really good, along with treasury stock continually going down lower and lower, a bigger negative number. So with retained earnings, that is referring to how much do the earnings stack up every single year. If a company has a loss, then that eats away at the retained earnings category. So this number going up every year, good. Treasury stock getting bigger, the magnitude or the absolute value getting bigger, but obviously a bigger negative number. That also looks good. They are continually buying back stock. Finally, in the cash flow statement, the cash flow statement is divided into three major categories. The cash flow every year for their operations. Generally, I want to see a big number here. I want to see more cash going into PayPal than leaving PayPal regarding their operations. If that's a negative number, it means they are losing money from their core operations, which is not good. The next is investing cash flow. In this case, PayPal had more money come in from investments than they did cash flow going out to actually invest into things. We can see here that they spent $683 million on capital expenditures. They had $753 million come in from their investments. So maybe they sold some of their investments, and then other investing activities, they received $3 billion. So that's fine. That doesn't really jump out at me too much. What does jump out at me is their financing cash flow. I like to see a negative number here. That means they are paying off their debts. They're not having to use financing to bring cash in. This is the row that I love to see. Repurchase of common stock. This is where a company is putting money into buying back shares, and that way shareholders like you and me, our shares become a bigger slice of the pie. It increases the value of our shares ownership, which hopefully translates into higher share price. And normally it does. I love share repurchasing because it grows my slice of the pie without paying taxes. So a dividend is also great. The company could be using this money to pay dividends. In some ways, repurchasing stock is better than using that cash to pay a dividend, because if I receive a dividend, I have to pay taxes on that. If I have share buybacks associated with my investment, I don't have to pay taxes until I actually sell the shares of the company. So that's a nice little bonus. Now, whether dividends or share buybacks are better, that's a debate for another video, but I love to see at least one of the two. Scrolling down a little bit further on the cash flow statement, we have the free cash flow. Now, this is the number that I care the most about. This is showing me their past free cash flow. And for the most part, it is up and down. Free cash flow is going to be a little bit more lumpy than net earnings, but that's fine with me. I can see their free cash flow margin. This is the percentage of revenue that they're able to turn into free cash flow. And the free cash flow, this is what the company is able to spend on returning value to shareholders, whether that's paying off their debt, repurchasing shares in this case, paying a dividend, or cash acquisitions. It could be expanding their capital expenditures, their property, plant, equipment. There's lots of things the company can do to pay back their shareholders. And in this case, PayPal is using that free cash flow to buy back shares. And we can see it really mirrors it. In 2024, free cash flow of $6.7 billion, and then they repurchased $6.4 billion. In 2023, they got $4.2 billion in free cash flow. They repurchased $5.2 billion. In 2022, $5.1 billion in free cash flow, and they shoved $4.5 billion into repurchasing stock. So this is where that free cash flow is going. Looking at these cash flow statements and financial statements, it can be a little bit intimidating. And I know at first, when I first started investing, I would go cross-eyed looking at these documents. But the more I looked at it, the more I put in the reps, the more I was able to see the story that the financial statements are telling. And if you just stick with it and you keep looking at these and put in the reps, I'm confident that you will be able to understand and easily see the bigger picture. Now we're done looking at PayPal's financial statements. And the main thing I'm looking to take away here are red flags and green flags from the income statement, the balance sheet, the cash flow statement. And then I'm trying to understand their past free cash flow, and more importantly, their past free cash flow margin. This is what I am coupling with their future revenue projections to try to put together a picture of what I think the future free cash flow is going to look at. Future revenue times past free cash flow margin gives me future free cash flow. One way that I can find future revenue guidance is to look at the forecast tab on stockanalysis.com. And here is where the analysts have their average projections, the highest analyst projections, and the lowest analyst projections. The highest are looking at double-digit revenue growth for the next 5 years. That would be great. The average is looking at high single-digit revenue growth, and then the lowest analysts are projecting a little bit of revenue loss in 2025 and 2026, and then basically revenue going up with inflation for the next few years after that. And the way I can do that is by going to PayPal's Investor Day presentation 2025 right here. This is where they put together a slide talking about all their leadership, what they're planning to do, their past accomplishments. And right here is a table that summarizes their forward guidance. So their non-GAAP earnings per share, they are expecting 6 to 10% growth in earnings per share. They're expecting low teens by 2027, and then their long-term ambition is 20% growth. That's great. We don't use, or I don't use, earnings per share so much to calculate their intrinsic value. I care more about this transaction margin because this is what translates to revenue growth. They are guiding 5% transaction margin dollar growth in 2025, high single-digit growth in 2027, and then 10% plus is their long-term ambition. Now, revenue will not increase by exactly the transaction margin because this is not accounting for certain losses. It'll be slightly below this. So for my personal projections, just to be conservative, below 5% in 2025, I'm going to assume 3%. And then by 2027, they're saying high single-digit growth. I'm going to assume that PayPal is increasing their revenue by 3% in line roughly with inflation, and see what kind of intrinsic value that would result in. First, I copy all of this revenue growth from stockanalysis.com and I put it into my automated spreadsheet on the dashboard tab. Scrolling down, I've already done it. This is where I paste in the revenue projections, and here is where the intrinsic values are calculated. So the lowest analyst projections based on that revenue growth and the past free cash flow margin, which is about 20%, would result in a $95 share price. And when I go to PayPal's current price, I'm seeing $62.57. In fact, I want to look back at the last 3 months and see how their share price has been moving. So I'm going to click on the chart button here, click on 3 months. I can see that PayPal was up in the 90s just 3 months ago, and now they're at $62. So they've dropped by almost 30%. The share price has dropped quite a bit, which leaves me a huge upside. If the lowest analysts are correct, that would be a 53% upside on top of my discount rate. Now, I'm currently using a discount rate of 8.57%. I get this from alphaspread.com. It calculates PayPal's cost of equity. This is the percentage that I use for the discount rate. It takes into account the risk-free rate and the perceived risk involved with PayPal, and they use volatility to calculate that. It's a little bit over my head, so I use the cost of equity. I don't bother calculating that myself. So with that in mind, the lowest analyst projections are giving me an upside of 53% on top of the 8.5% discount rate. That is really good. However, I cannot just use the past free cash flow margin. I have to adjust the free cash flow margin because if we go back to PayPal's financial statement, they are able to increase their free cash flow by quite a bit by using stock-based compensation. They do not have to pay cash to their employees, this $1.23 billion. It gets added to the free cash flow because this is cash that they didn't spend. This is just stock that they issued. This decreases their earnings because it is calculated as a loss. However, it's not cash flowing out. So I need to reduce their free cash flow by their stock-based compensation. When I scroll back down to the repurchase of common stock, they are spending $6 billion buying stock. They're gaining $1.2 billion by issuing stock. So to me, that doesn't make sense. I can't give them credit for $1.2 billion when they turn back around and have to buy it back. So we're going to decrease their free cash flow right here with this table. I am using 100% against their free cash flow in the stock-based compensation. For cash acquisitions, I'm also counting 25% of their cash acquisitions against their free cash flow, because this is similar to a capital expenditure. When you acquire another company, you are going to increase your expenses to some extent when you purchase that company. They're going to have research and development. They're going to have capital expenditures that they have to pay. So some of that is going to be counted against PayPal. I'm going with 25%. They have very little capital expenditures, and the capital expenditures that they do have is mainly geared towards maintaining their current revenue. So I'm not giving them any credit for capital expenditures, and I am going to give them only 10% credit for their R&D. Normally, R&D is counted 100% against free cash flow. A lot of their R&D is required for just coming out with new products just to keep their current customers. But some of that is going to be bringing in new customers, in my opinion. So I'm giving them 10% credit for. The result is a new free cash flow margin of 14%. So I have to drop it by quite a bit. It was 19.5. I'm dropping it to 14.5. That means I have to reduce their free cash flow margin by 5%. Let's stick a -5 in there. And now the lowest analyst projections are only giving me an upside of 13% on top of the 8.5% discount rate. So this still looks really good. Now my projection right here, this uses these percentages to calculate their future free cash flow. I am assuming over the next 5 years, 3% growth, the 5 years after that, 3% growth, and then a perpetual growth rate of 3%. If that is the case, if they're able to just have 3% growth with inflation, then that's a 31% upside, which looks really strong. That's on top of the discount rate, and the highest analyst projections are giving me an upside of 105%. So with that in mind, I'm seeing a huge upside with PayPal. The downside I'm seeing is very safe, considering the lowest analyst projections are saying it's still undervalued based on their future revenue. In order to see the fair share price today, I would have to put in a 1% growth, and then at that point, I would be overvalued by 11%. PayPal is the company I'm investing in this week in my YouTube portfolio. However, by the time you guys see this video, it will have been about a week since I filmed this. That is about how long it takes for me to produce and edit these videos. Now, in one of my past videos, Aaron asked me, do I have a Discord? And Aaron, no, unfortunately, I do not have a Discord at this time. I still consider myself to be pretty new to the YouTube game. But that got me thinking, if I had a Discord, that would be a great way for us to discuss the companies that we're looking at. We could share more information with each other. That way, if you do want to invest in the company that I'm looking at, you can make that happen a lot faster. I would also be able to share my spreadsheet as I'm tweaking it and changing it in real time. I've had some other commenters asking, hey, do you have this on your spreadsheet yet? I'm not seeing this feature on my spreadsheet. Well, I have two versions of the spreadsheet. One that I released to the public that I know works, and then another version that I'm constantly tweaking and working on, and I'm a little bit slower to get that out. If you were in the Discord, I could also make available my spreadsheet that I personally use that I'm constantly tweaking. If that is something that you think you'd be interested in, let me know in the comments. I would be really curious to hear your perspective. Now I want to review our YouTube portfolio series and see where we're at in the current market. We have put $1,800 invested into the portfolio. We're down $133. So in total, we're down less than 10%. However, if you're going with the money weighted rate of return, which takes into account the time that you invested and uses that to calculate your current gains or losses, we're down 12%. We're still doing slightly better than the S&P 500. If I switch over to that, since we started about 3 months ago, the S&P 500 is down close to 15%. So we're doing pretty much in line with the S&P. Of course, the goal is to beat the S&P. And as the stock market is dipping, we're going to be targeting companies that have gone down more than the greater market, but are projected to do better than the greater market. That's the plan anyway. So our investments are right here. We've got Crocs, ACAM, Him, Simply Good Foods, British American Tobacco, Adobe, Canadian Pacific, DocuSign, HCA Healthcare, Capital One, American Express, Usana Health Sciences, Canadian Natural Resources, Alphabet, and Zeta. So these are the companies we have, the ones that are doing well right now. British American Tobacco is my best holding. And one that I'm really surprised is down so much is Google. It's down almost 20%. I think Google is looking really good. My worst investment so far is Zeta. It is down 32%. At the time when I invested in this company, I did outline that it was a higher risk, higher reward stock. However, I did miss the fact that it has tons of red flags, according to Warren Buffett. Since I've lost such a high percentage on this company, I am now paying extra close attention to the red flags associated with the financial statements, and I talk about that in this video right here. Cheers. TX bourbon, pretty good stuff.